Alrighty. Knock, knock, knock. Who's going to
Honey,
open
can you
the
get that? I got it. Hello.
Hi, Joshua. Is Samantha here for our 6 o'clock?
Come on in. Thanks for coming.
Perfect. Okay, cool. Did you made sure to let Lorinda know, right?
Oh, absolutely. Yeah, she's preparing some tea for you.
Oh, wonderful. Good. Okay, we get to the table. All right, guys. So again, like I said on the phone, I'm a broker, so I work with over 30 companies. My job today, I'm going to ask you a few questions. Some are going to be financial and a few are going to be medical, and that's going to help me narrow down the choices as far as what's going to make sense to protect this mortgage for the both of you for the long haul. Does that all make sense to you?
Sure does.
Okay, great. We're going to jump right into it. So I'm going to start from the top.
Still on mute. I'm sorry. Can y'all hear me now?
Yeah, we can hear you now.
Okay. I'm sorry, y'all.
No problem. Okay, so again, I'm going to ask you a few questions. Some are medical and some are financial, and that's going to help me narrow down the carrier that's going to be able to fit your need, make sense for you on the health profile, and also fit your budget. Does that make sense?
Yeah.
Great. Okay, so I'm going to start at the top. The mortgage amount I show is $250,000 through SBC mortgage. Is that still accurate?
That's correct.
Okay, and are you guys monthly paying what on that mortgage?
It's about 1,800.
Okay, are you paying anything additional?
No.
Okay, and is that a 30-year note?
Yes.
Perfect. And Lorinda, what is your birthday?
March 30th, 1985.
Alrighty. And that makes you 35 or 36?
36.
Okay.
36.
And Joshua, what's your birthday?
September 3rd, 1974.
Okay. And that makes you how old?
47 tomorrow.
Thanks. Man, cradle robber. Happy birthday, Josh. All right. And do either of you guys take any medications?
No, I don't.
No.
Okay. Anything in the past 10 years at all? Except antibiotics. Those don't count.
Just ibuprofen.
Okay.
I mean, over the counter, nothing prescription.
Okay. Any major
No, nothing for
surgeries?
me.
Any narcotic pain medicines for any kind of outpatient surgery, even breaking a bone, anything like that? Any anxiety medicines or depression medications you may have been on short term or long term?
No.
I think I was prescribed some pain meds after a car accident earlier this year.
Did they just give it to you in the hospital, or did they have you take some home with you and do a few refills?
It was just one bottle picked up at the HEB.
Okay, perfect. And then do you guys have anything in place that acts like life insurance that would help take care of the mortgage in the case of something to happen to one of you, such as a life insurance policy, significant savings, a 401k, anything like that?
401k.
Okay. For both of you or just the one of you?
Just for Lorinda.
Okay. Approximately what's the value on that fund right now?
I think there's like 45.
Okay.
45.
All right, perfect. And you're still working, right, Lorinda? Great. And what is the approximate income for the household?
What do we make Lorinda combine? About 80? About 80?
Yeah.
Perfect.
80 together?
Sure. We've been known to stay out of each other's business, but every once in a while, well.
You're killing me. You're killing me. All right, guys. All right, got that down. All right, so, and then are you guys smokers or non-smokers? It appears to be non-smokers, right?
Correct.
I'm a non-smoker.
Perfect. All right, guys. It appears to me that you're going to qualify for just about any program that I would offer you as far as mortgage protection goes. So what I'm going to do is I'm going to tell you a little bit of an overview of the 4 levels of protection I generally recommend to people. And then from there, you can tell me what interests you the most and I'll run some numbers. Does that sound fair?
Yes.
All right. So the first policy I generally recommend to people that are in your health profile is called a cashback policy. Now, a cashback policy is exactly what it sounds like. It's going to protect you for the 30 years of your mortgage. And at the end, they're going to give you your money back 100%. The other benefits that come along with this program include what's called a living benefit. And a living benefit means it's going to cover you in case something happens and you don't pass away, such as a critical, chronic, or terminal illness, meaning like a heart attack, a stroke, or even if one of you were to, contract diabetes and lose a limb and you couldn't work anymore. If you can't do two of the main living functions, you're going to be able to actually take the majority of this policy to either replace your income or pay off a majority of the house during that 30-year period. Now, in the best case scenario, you guys actually survive the policy, which will put you guys, squarely around the 60, 65, 70, age range. You're going to actually get 100% of this money back tax-free. That's the most that's obviously the policy that has the most bells and whistles. The second policy that I often recommend is what I call the term 125. That means it's going to cover the total mortgage for the full 30 years. It's a little bit more cost effective on a monthly basis because at the end of the policy, you're not going to get your money back at the end. But on a monthly basis, it's not going to cost you quite so much. The other benefit is that if something does happen, it's going to give you an extra 25% if you were to pass of an accident. This policy also has the living benefits, just like the cashback. So really the only difference between the cashback and this term 125 is that the first one gives you your money back and the second one doesn't. Does that make sense?
It does.
Yeah.
And this is like one big joint policy for us both?
Actually, all policies in Texas are written per person. There are certain policies where they're kind of joint ownership, but in this case, I prefer to write them separately so that you guys are each your owner of the policy. In the case that things, whatever reason, one of you passes away, the other one still has protection for the mortgage to take care of as a survivor, and you never know. She may not like you tomorrow and she wants to change a beneficiary, get a new husband, and I always make a joke there. Now, the third way that most people cover for the mortgage is what we call traditional, what most people would remember is kind of a traditional mortgage policy. It's a decreasing term. So it starts at the whole value of the loan, 250, and over the 30 years, it's going to drop linearly to zero. So it's not going to follow your mortgage exactly, but it is going to drop in benefit value over time. What that does is it's going to make the cost for your monthly much lower, because the company is taking less risk over time. So they're able to basically smooth the premium cost. And this policy does not have living benefits and it does not give you cash back in the end, but it is much more cost effective on a monthly basis. And a lot of my clients choose to go this route. The fourth way is what we consider an accident policy. I'm sure you've heard of it. It's going to cover for the full mortgage for both of you. You can choose to have your cash back at the end if you so choose. But it's only going to cover if something, God forbid, happens accidentally. Now you're both very healthy. So more than likely anything in the next 30 years will be an accident. So this is a valid option if monthly this, cost is going to be something we really have to take into account. This is a great option, but a lot of times I call it cherry on top. So I'm going to use this policy on top of one of the other three options just to make sure you guys have not only your mortgage taken care of, but also the income protection for your lost spouse. Does that make sense? Okay, of those four options, just off the top of your head, which ones are kind of singing to you the best as far as value and what you guys want to look at on a monthly basis, or what you want me to pull the numbers on?
I do like the sound of getting cash back. After you get the cash back, is the policy still going to be in place, or what happens?
Right. So at the end of 30 years, the policy actually ends. So you'll get your cash back. And at that point, what I generally do with people is as we move through the next few years, if you guys want to put additional policies in place that are going to outlive this 30-year policy, we can absolutely do that. But this particular policy will expire in 30 years and give you the money back. And then you guys can do what you will with it. You can pay up your burial and not get any additional insurance, or you can buy another house, put a down payment, purchase a car, put it towards retirement, whatever you may choose. But generally I say, I'm going to stick with you guys throughout the next 30 years. So as time goes on, you guys have children or things change, Lorinda, you decide to stay home and Josh becomes more of the breadwinner. We'll obviously put some more coverage on Josh to cover for the household, to make sure that, you know, if you and the kids will be able to stay home or at least make wise decisions if something did happen to Josh. So we'll kind of edit your coverage as we go throughout the years. Does that make sense?
Yeah.
I don't have to choose a cashback option, do I? Because that I'll be late into my 70s by then. So I prefer something that's just more monthly cost effective. So is that possible for me to do a different plan than Lorinda? Okay.
Yes, because, you know, I'm glad you brought that up. Like I mentioned, these policies are individually owned. So you own your policy and she owns hers. And I also wanted to bring up, you guys, you know, currently both work. So we can do half the mortgage on each of you, or we can cover for the full mortgage on both of you. It's completely up to you. Either way makes perfect sense to me. And if you ever want to increase it, as long as there's no changes to your health that are major, we can always do that. Do you guys want to look at half the mortgage on each of you, or do you want to look at the full mortgage on both of you?
We can take a look at the full, and then obviously if the price is prohibitive, we can always just kind of just slash it down the middle and just kind of figure out about what that's going to be.
Sure. And Josh, did you want to look at the traditional decreasing policy, or did you want to look at the policy that added the 25% in terms of in case of an accident and had the living benefits, but not the cash back?
So which one is the decreasing one? What's that one called?
It's called the payment protector.
Payment protector. Okay. Yeah, I guess the decreasing may make sense because obviously the mortgage will slowly decrease. But I actually know that I think I'd rather keep it level because I think it just makes more sense to keep it level.
Yeah, I agree with you. I mean, just because again, it's privately owned, so the money's not going to the bank. The money's going to Lorinda. So if you pay down a lot of the house, she's still going to get that full benefit. She can use that additional money for income protection, whatever she may need to pay down in case something did happen to you.
Yeah, it may reduce the need to get additional coverage on me later, because if it's decreasing, then
you would need more policies. You got it. Okay, let me run that real quick for you here. Okay, and then let's do Miss Lorinda, Texas. Girl, I'm with you. I'm like all about the cash back. I'm just saying.
Yeah. I mean, and then, I mean, I'll be 66 years old in 30 years. How hard would it be for me to get life insurance, or should I go ahead and do something about that now? Or
so like I mentioned, before you get too much older, if you want to have a permanent policy in place, it really depends on what your goals are. If you want to have just enough to pay for your burial, you're not really going to need anything else because your cash back will pay up your funeral. Now, if you're one of those that wants to have what they would call quote unquote legacy money for your kids or your grandkids, then before you get to an age where it becomes too expensive, we'll put something permanent in place that will turn into a legacy fund for your kids and grandkids, and that will stay in effect for the rest of your life till 120. Make sense?
Mm-hmm.
Perfect. All right, guys. So if you, since we're on a Zoom call here, if you don't mind taking these numbers down so that you guys can kind of visualize it with me. All right, let me do a little math here. I'm in insurance, not a math major. Just a second.
I need it, yeah.
All right, Miss Lorinda. For you, the 250,000 cash back is going to run 155.42, and in 30 years, that's going to yield you a $55,951 cash back, which will definitely take care of your burial. And if you were to go with half the mortgage or 125,000, that rate would be $77.71, which would then yield you in 30 years, $27,975. Okay. And then for Josh, the 250,000 decreasing term is actually going to run you $230, and the 125 is going to run you $115. So it's completely up to you guys how you want to mix and match this. It's up to you. From here, I just answer questions and you guys tell me which option is going to make most sense for you on a monthly basis. Like I said, we can always increase this as long as your health doesn't change dramatically.
Gotcha. Yeah, that 115 is a pretty fair number for me.
Mm-hmm.
Yeah, I'm gonna go with the lower cost option for me. I'm gonna go with the $77.
Sure. So the one thing we can do, I like that way you guys are thinking, plus 77, that puts your monthly at 192. So Lorinda, for a couple of extra dollars, probably about $8, we can actually double your benefit from 125 to the full 250 in the case of an accident, if you want to have that benefit available. So basically natural causes will be the 125, but if you do have a car accident or trip or fall or have some kind of crazy thing happen, it'll pay the full mortgage off for your husband. Do you want to go ahead and add that for about $8-10?
Yeah.
Okay, great. And Josh, they don't allow me to add the accident onto yours, but I can write you a separate policy for the same kind of thing for about $10. Does that sound good?
The same kind of thing being a $250,000 policy, accident
Right.
policy.
It would be an additional 125,000 accident essentially. So if you did die in an accident, it would pay out your natural
A
causes
125 accident.
plus another 125 accident. So it would pay the full mortgage if it were an accident for an additional $10.
Okay, gotcha.
Does that sound like a plan, or do you want to just
Yeah,
leave it with the natural causes?
Natural causes one. I don't.
That's fine.
Natural causes one is fine for me. Yeah.
Okay, perfect.
And mine's for the. Is mine for the? That's right. Mine's for the 125. That's right. I'm sorry.
Yes, both of you chose the 125 natural causes. Lorinda is adding an additional $10 to have it double in an accident. You can choose to do the same thing if you want.
Okay.
Okay.
Gotcha.
All right.
No,
I
that's.
have a question because we have two incomes. So I have a question because we do have two incomes. If one of us was in an accident and became disabled or something like that, is there anything with that feature that would allow us to take advantage of something extra during
So
that
for
time
you-
of being disabled?
Absolutely. So for you, yes, because you're going with the cashback policy, it does have living benefits. So if you were in an accident and you were no longer able to do two of the main living functions, basically after 90 days, you could access a good portion of this policy while you're living, and then the rest would pay when you passed. Josh is going with the more cost-effective monthly, so his won't have any living benefits in the case of something happened to him, but it is going to cover, for the mortgage in the case of something happened and he did pass away. Are you still okay with your answers and want to move forward with these policies, or do you want to? Oh, I'm wrong. Josh, you went with the level benefit. I'm wrong. You do have the same benefit as Lorinda. My fault. I got confused from earlier. He does have the living benefits, Lorinda. My apologies. So if either one of you, same deal, something happens, you will both have access to that money if you cannot do two of the main living functions. My apologies. I got mixed up in our options. Any other questions?
Okay, so
Okay. Last question for me. What bank do you guys tend to work with? Who do you have a relationship with?
Wells Fargo.
Okay, perfect. I'm gonna get my
Yeah,
computer filed up.
yeah, we'll have Lorinda make payments for both of us.
I got you. I'll let you guys work that out. I'm just gonna turn my computer on and get going here, okay? All right, any questions, guys? That's the whole appointment. And honestly, that's how most of mine go. Like, I don't get a lot of pushback. Mostly because I think that explaining high level, the 4 levels, and kind of gauging where they are from a value perspective before you throw numbers at them uncomplicates the whole process. In the beginning, sometimes if it's a low enough mortgage, I'll just show the numbers for all 4 options for both people and just say, these are your 4 options. And I'll put like $4 signs next to the cash and $1 sign next to the accident. And then like decide which one fits your value the best. But I've recently been going to just more of an explanation of all 4 products in the beginning before showing numbers and gauging where they live, as far as like what matters to them. Cause like Josh was like, I don't care about cash back. I'm gonna be an old fart. And Lorena's like, I'm gonna be getting like a husband when I'm 66. I need some dough. And so everybody's different, right? And so I don't presume like, and half the time I always say, we can always cover the full mortgage on both of you, or we can do half and half. What makes sense for you before I even show them numbers, because you gauge kind of what people care about. And then, I mean, you can always show them both if they ask to see both, but generally you're saving yourself time and you're keeping the numbers simple if you just do a little bit of that footwork in advance of you doing your quoting. And then, I mean, that's literally how all my appointments go. They pick one and then I write it up. Like it's you, when you do it like that, there's no answer where it's like, no, right? And even if I had shown them something that was too expensive, I would have said, look, like I said, all 4 of these programs cover for the full mortgage. So if the top 3 don't make sense for us, option 4 is still going to cover for everything that happens in the case that you were in an accident, something more likely. Okay. And you're still going to get your money back. We can return a premium this. And they're like, okay. And I'm like, and again, I'm going to give you guys a call every year. If down the road you do decide you want to move forward with a cash back or something like that, we can absolutely put that in place. And they're like, okay, great. And then they feel good about even going with a lower option. I'm going to get a client for life. Does anybody have any questions about how to do a mortgage appointment? Okay. One thing is if you are in an area or you're dealing with someone who's very, very mature and they have a $200,000 mortgage and they're 65 or 70 and they're not going to, like, they may not qualify for term, you're going to spin the whole thing a little bit, right? You still ask all the same questions and you say, okay, guys, so generally what I do with my clients in this age group is I cover for what's called the critical period. So you guys have built up about $60,000 worth of equity in your home at this point, and you figure that out by asking them what's left on the note and what they think they'll sell it for, right? That's the equity. So what I would recommend is based on your mortgage payment that we put in place X number of coverage, whether that be $30,000, $40,000 for each of you. And that's going to cover for 2 to 3 years or whatever the amount is for each of you guys. And, or sometimes it's like, you know what, John, when you pass away, or if Sheila passes away, you guys are going to be able to keep the higher income. Your husband has his retirement, he has his military benefit. So your income is going to stay about the same. You're going to get to keep his higher income. So we're not worried about you being able to survive, but we do want to make sure that you can pay down the mortgage a little bit and get ahead of things. So we want to cover for critical period insurance for your husband. I recommend you put about $40,000 on him to cover for the full equity. And then whatever you guys can afford on a monthly basis outside of that, we'll cover for your wife as well, just to help you out, Joe, in the case of something happened to her first. But I've got to be honest, she gonna outlast you, right? And he's like, yeah. And so, I like, no matter what, this has to fit monthly. So you guys we can do it 2 ways. I can run a whole bunch of numbers and you can tell me what fits, or you can tell me right now what's going to be something that you can live with on a monthly basis. When you look at your bank statement every month, you feel protected in your policy versus harmed by your policy. And then I can build back the highest level of coverage for you both from there. And then they usually say, okay, we could probably do 100 or 200 a month. And then based on who has the income and whatever health conditions they have going on, I'll build backwards from that to get the most coverage for each person. Or in some cases, you're just putting it on one person because the other one has it, whatever the case may be. So when they're older, you're trying to do critical period. If they're under 70, you can still write them an accident. And I say, you guys are still super active. You're still getting out there and doing things in the community. I recommend you cover your full mortgage with this accident policy. It's going to last for the next 11 years, and make sure if anything happens, God forbid, your house is paid off, and you guys won't have to worry about anything. And it's so inexpensive, for you guys. And they're like, okay. And they'll usually bite on that. And then I say, we'll do critical period for, we'll do 10 or 15,000 per person in case something happens that isn't an accident, to buy you guys time to make good financial decisions about the property. And they're like, okay. Those are tough appointments though. Colorado, you're probably going to be doing more equity protection than, full mortgage, but you can always do the full mortgage on an accident, especially if they're young. I call it cherry on top. Any questions?
On the decreasing term, what is it? Is it over 30 years and it just decreases the face by 1/30th every year?
Mm-hmm. And your payment doesn't get cheaper.
Oh, okay. That's kind of a bad product then.
I mean, it's a good product in certain circumstances, right? Because I've seen it be $47 for a mortgage for someone. And it made perfect sense because they really couldn't afford a lot. And it made good sense. They're like, yeah, this is great. I need it to be cheap. I need to do the job. Like, write it up. And then sometimes people are like, well, I want to have the value retained if I'm going to pay that long. And I'm like, that's why I don't presume anymore. I just tell them how they work. What do you think? And then they tell me how they think. And that helps me figure out what's going to really fit. And if after you know how much income they have, you know whether you should be showing full mortgage on 2 people or half a mortgage on both. Or if one person's working, you're covering the whole mortgage on one person and maybe just putting some final expense or accident policy. That's what I did in Bastrop. I covered the husband for the full mortgage, doubled it in an accident. And then on the wife, I just did a $25,000 cashback policy to cover her final expensive and get her cash back in 30 years. And we didn't even do the accident on her. She decided against it.
Do all of the providers do the double on the accident, or it's only specific carriers?
America, you can double the cash back on the 125. It already has 25% built in. The decreasing doesn't have it, but what I would do is write a mutual Omaha accident on top of it. So I'd write 2 separate policies if they wanted it. So when I say double, I'm like, you're going to have this and then this one. So it's double, but it's not the same policy.
Okay.
But I think John Hancock does double accident. You'll just have to check that though. If they don't, just do a mutual Omaha, return a premium.
So I have it sounds like it's going to be a similar situation tomorrow. So I set my first Zoom because we were kind of pushing and like scheduling. And then I just like brought up Zoom and he was like, oh, good. Yeah, let's do that. He had a group policy at work. Work shut down during COVID. No longer has the policy. He's in his 60s with some health conditions. He's bringing his wife on board. Sounds like his house is pretty nice. So it might be a difficult situation where maybe putting one of them in a higher whole life policy and then having a term for the other. So at least one of them covers the house. We'll have to see when we do it. I think the only thing, and I think about stuff too much, but is when we get to that point, you know how we pivot carriers, but being able to smoothly pivot into how you do the signing of the application via Zoom. So don't kind of screw up the whole thing or like, turns into this whole like mess.
When you do share screen, if you share, and then there's an option normally that his like remote share, and then they can use their mouse to tablet sign. Or you can just do email signatures while you're on Zoom. Let them pull up their email and watch them do it. They can share their screen so you can walk them through it and just let them email sign in person, like right there. And you just—
So everyone has an email signature on there? Because I was looking at each carrier to make sure, because I know
most of them do. Most of them do.
Okay, just to—
Any of the ones that you're going to have to work with probably will.
Okay, so that's always a good fallback, like if there's technical issues or something with remote, or if they're on their phone. I don't think you give
so when I've dealt with people in the past where they have like a high amount of coverage they need, but they got the money and they want to have it, I always build the value first. So I'm like, look, with your current health conditions, what we're going to need to do is you're going to, the good news is you qualify. We have programs, lots of companies that do it. The downside is a little bit of a hiccup is that they each kind of, their coverage amounts like 20, 30, 40, they're in little pieces. So we're going to stack those on top of each other. Now there's 2 things that helps. When we do that, down the line, as your mortgage decreases, you can cancel some of these policies without losing all your coverage, right? In 5 years, you've paid down 20,000. You can take care of that Foresters and kick it out of here, right? And then in 5 more years, you can take that Aetna and drop it off. And you're going to get cash value back out of those policies, even though you're canceling them. So you're not losing anything, right? You're getting the coverage while you need it, and then you can slowly trickle it down as time goes on, and you're going to retain some of that cash value that you can even put back into those other policies to help with those premium payments over time. The good news is that these payments today, you will lock in a rate and it will never increase. So whatever comes up today, that's the most you'll ever pay for this this coverage. And then as you tier down your programs, it'll obviously decrease your monthly cost. And then you can put that cash value back into your policy or in your pocket.
I like that strategy. That would
Yeah.
make a lot of sense. Yeah.
It gives them more power and control over how they want to manage their coverage. If it ever does be, you have some big bill come up, no worries. Like you can just drop one of these policies without losing all your coverage.
Cool. Yeah, he came in as a final expense, but just as kind of assessing the situation and kind of seeing where he's at. There might be
Sure.
some room for other, filling up the gaps with insurance.
You definitely want to hear out everything and get as much information as possible about all the other programs and policies and anything he may have in place or savings. People like that always have something hidden in their back pocket. They're not telling you. And they're just waiting till the last minute to say, I'm just going to use my $1 million to pay it off instead. Like, well, you could have started with that, sir. Just, and if you want me to be on that Zoom with you, I'm happy to.
Yeah, that'd probably be helpful. Just because this is my first Zoom and
No
be
worries.
smooth.
Okay. Any other questions?
I don't think
Okay.
so.
We're going to start reaching out to everybody this week, one-on-one, to do little quick touch bases. If you have a specific time and day that's better for you, let me know. I'll try to accommodate, but it'll either be myself or Cass. If you don't get a call this week, since it is Thursday, it'll definitely be early next week. And if you know anybody that's been a little bit disconnected over the last few months and they're please try to touch base with them, get them re-engaged, because there's so many exciting things going on that people didn't have access to, these different lead vendors that I think are really going to push the last quarter for everybody and make it a really, really Merry Christmas for everyone. So please try to get the word out and re-engage everybody, get them on these trainings. And tomorrow morning is the FFL financial training call at 11 Central, 9 Pacific, and Jack and I are going to do phone training. I've actually changed my script quite a bit in the last 2 weeks, and I've seen a really, 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 really positive show ratio. So I'm going to be sharing that with you guys prior to Indiana. I'm going to be sharing it at Indiana as well. But I'm going to go over that tomorrow with you guys, and we'll be doing a lot of rebuttals. So if you are struggling on the phones with rebuttals, jump on and please share with your friends that you talk to and make sure they jump on as well. Y'all have a wonderful night. Yes, go ahead.
It's just, this was with Americo. So when I did a quote, like this is from my mom. So 120 a month, they give you a monthly premium.
Mm-hmm.
And I know, with carriers, you get a discount if you're looking at doing a whole, the whole year. Right. Yeah. So it doesn't do that in the calculator. So how would I determine how much, if she could budget, say 120 a month, but she could budget, say 1,200 up front, how do I find where that kind of overlap?
Call Americo and ask them for the annual rate on the policy, and then write it up monthly, and then call them and then just edit it to annual, and they'll credit her the first month towards the annual payment.
Okay, cool.
Yeah, it's probably like a 4% discount. It's not a
Yeah.
big number.
Oh,
my
it's not,
guess.
yeah, I was just seeing how far that 1,200 would stretch, or if she was better off going the other way. Okay.
Yeah.
For sure.
Well,
All right, guys.
Remember,
Thank
but
you.
120 a month isn't 1,200 for the year. That's only 10 months, but that's besides the
True.
point.
Yeah, no, that's it kind of falls in this little gap there. Yeah.
Yeah, no problem.
All right, guys. Have a great night, and look forward to talking to you later.
See ya.
Thanks, Sam.
Thanks, Sam.
Bye.
Bye-bye.
Bye.
Bye-bye.
Thank you.